Hello, everyone, and welcome to the Quest Trust Company Self-Directed IRAs. Today, we have a real treat for you. We are going to have Michael Planks. He is the founder of the REI tax firm and is the national authority on IRS taxation and real estate business. Michael, also known as a black belt in real estate taxation, frequently writes and speaks on these topics. He's federally licensed enrolled agent with over 20 years experience representing clients in dealings with the IRS, audits, letters, collection matters, and his expertise lay in tax preparation, tax planning, real estate, and business operations. Michael is a first-generation Russian immigrant who came to Houston with his wife and his first son in 1992. Since then, he's raised 3 sons, multiple cats, a few eyebrows, and he is an award-winning public speaker, animal rescuer who enjoys music and martial arts. Michael, it is a pleasure to have you on today. Please take the floor.
Okay, thank you. Okay, so first is, I appreciate the introduction. The introduction mentioned black belt in real estate taxation, and that explains, the way I dress and the way I look when I perform in public. So, here is my black belt. Here are my red gloves, and my logo always shows me punching up this guy who is standing right behind me, ready for a fight. And somebody needs to take the fight to him, and that would be me. Okay, so what I'm going to do is I'll share the screen, give you an overview of what we are going to be talking about, and we'll go straight into our presentation. Okay, so here we go. So our topic today is IRS Audits, Myth and Reality. I'll finish my quick introduction basically by saying already was introduced as a black belt in real estate taxation, and I have a license which is called Enrolled Agent, or EA. That license is for people to represent clients in front of these guys. So I'm specifically trained and in fighting the IRS on your behalf, and this is part of what we do. I've been in practice since 1996, and what is important for our presentation today at Quest is that we work in my firm exclusively with real estate investors. All of our clients are in real estate, and I beat up the IRS, so you don't have to. Okay. If you go check our ratings, my firm is called REI, which is Real Estate Investment. Okay. REI tax firm has 5-star ratings everywhere where you can find. Okay, you can go on Bigger Pockets, where I'm consistently one of the highest ranked people on the tax forum. And now let's see what we're going to discuss today. So our agenda is this. We're going to talk about how far back the IRS can go when they audit you. We will talk about what are your chances of an IRS audit, what are the consequences of an audit if it goes wrong, what are the triggers for an audit. I will show you examples of IRS audit flags, and we'll talk about different types of IRS audits, and finally, audit success keys. So I hope there will be useful information, but in order to determine if there is useful information for you, right, what we're going to do is start with a little quiz. Okay, and the quiz is a true, false type of questions. So we'll go through a few of them just to give you an illustration of whether what we're going to discuss today will have new information for you. So first one. Okay, the IRS has 3 years to audit me, and since it's 2023 right now, that means 2019 is past the 3-year window, so it's safe, and now is a good time to trash all of the receipts from 2019. Answer to that question, false. Later today, I will explain why. So right now, it's just a quiz to see, how much you already know about IRS audits and whether you need to listen to the rest of the presentation. Second, the IRS audits approximately 1 out of 5 returns. So it's like 20%, 80% gamble. Okay, it's true that it's a gamble. It's false that it's 1 out of 5 returns, and we will talk more about that. Next is partnership tax returns are audited far less frequently than individual tax returns, so it is safer to file as a partnership. This argument is very often brought up by real estate gurus and tax coaches. Okay, so true or false? Well, this happens to be true. So not everything I tell you is false. Occasionally the answer is true. Next, if my tax return is signed by a CPA or an EA, which I remind you is my license enrolled agent, then my audit chances are much lower. You already can see true. Next, if I lose my IRS audit, I will pay the same amount of taxes that I owed before. So the question is, do I really have a risk, like downside of being more aggressive and claiming additional deductions? The game goes like that. Okay, if I claim it, the IRS does not audit me, I win, I keep it. If I claim that IRS audits me and I lose, well, I'm in the same position where I was before, so there is no downside. True or false? Answer, false. Not the case. We'll discuss it during this presentation. Next, if I'm audited, that means the IRS found something wrong on my tax return. Everybody knows that that's how it works, but it is false. And again, we'll talk about that later today too. And I think there is one more true false question. Without receipts, I will lose all of my deductions to an IRS audit. False. And oh, sorry, one more. Okay, and if audited, I must hire a tax lawyer to defend myself against the IRS. That's the final question of the true false, and it is false. Okay, now let's go into the actual material of our presentation and discuss those fun, exciting events that are called IRS audits. Like here in my office where I sit right now, I had countless people over my almost 30 years in practice coming there, hands trembling, IRS envelope. I actually have some IRS envelopes right here, probably. Yeah, like this, like okay, and like and their hands shaking. I see, like it says at the top, IRS. Okay, I like hands shaking and then saying like, what's going on? I'm saying, oh, I'm audited by the IRS. I'm saying, so what did they say? I don't know. I didn't open the envelope. I'm afraid to. So to me, it's okay. If you open the envelope, most of the time you will find something other than an audit. Okay, so let's talk about all of these things that I listed first on the agenda, starting from how far back. The general rule that I put in my true false quiz was 3 years after filing. That is correct information, but we have to put an asterisk to that and specify that this is quote unquote normal situation. Normal situation is IRS have 3 years after filing. So right now, okay, we are in 2023, just finished if you had an extension filing 2022 returns. So what you can be audited right now is 2022, 2021, 2020. So technically 2019 is past the 3-year window. However, what you need to remember is 3 years is standard but not hard limit. IRS, for example, has 6 years in situations that they consider more important issue. What is more important issue? If they believe that you underreported more than 25% of your income. Okay, 25% of your income is not such a difficult number to exceed when you are in business for yourself. So will the IRS, does it mean the IRS will go 6 years back if that happens? No, as a practical matter, it happens very, very rarely. But it can happen, and the IRS can use it as a weapon against you. The important piece in that information is, should you fear the 6-year instead of 3-year window? No. But the important point is, don't throw away your documentation, which goes past 3 years. Because if the stack is really like, if the audit is really stacked up against you, you might need to go past the 3 years. There is such a possibility. So don't rush and throw away everything that after 3 years. 6 years is a much more safe window to keep your documentation. Another thing to remember is they are talking about an event during the 3 years. Let's say that event was sale of a property. You sold something 2 years ago. Well, when you sell it, in order to determine capital gain, what do you need to know? Or what do they need to know? Or even more importantly, what are they going to verify? They're going to verify how much you paid for the property originally and the value of all improvements made throughout this period, possibly depreciation taken over the years. So what does it mean? If you sold a property 2 years ago, which you bought 15 years ago, does it mean you keep 15 years worth of documentation? The answer is yes. If you want to be protected from an audit that happens like this, it's 3 years after the event. And if the event was sale of a property, you need to keep all the information related to the property for 3 years after it's sold. Or as I mentioned before, 6 years is even safer. So if you cannot prove how much you originally paid for the property, you may be in trouble, even though the purchase happened to be a lot, like many, many years ago, way past even the 6-year window. Okay, next thing is, if you never filed a return, the IRS has forever to go past that year. So if you never filed your return for 2005, today is 2023, can the IRS look into your 2005, pursue? Yes. Is it likely? No, not likely at all. But they do have legally that opportunity to go after your unfiled return as far back as your date of birth, if you want to go that far. Okay, but what happens in practical, in real life, is usually it happens 1.5 to 2 years after your return was filed. So let's assume that you filed an extension this year. You were working on your 2022 taxes and filed it in October, just a few weeks ago. So what do we have? Well, 2 years from now is what? That will be late 2005. So when are you likely to see a notice if your most recent 2022 return is going to be audited? You are not likely to see anything from the IRS today or in December, 1 month from now. You are likely to receive something in the year 2025. So many people believe is when they did electronic filing, there is a confirmation that comes, says the IRS accepted your return. And people say, accepted, I'm safe. Or they say, well, they gave me my refund. Very important to understand. Refund and audits have nothing to do with each other. You received your refund, good. The IRS accepted your returns means accepted for processing. Doesn't mean they accepted everything that you stated on that return. They still have up to 3 years or realistically 1.5 to 2 years to go. So you cannot yet breathe thinking that your 2022 return is safe. No, unfortunately, it's not. It will probably be safe after 2025 because towards the 3-year time limit, they very rarely start an investigation. It has to do with their internal procedures. But until the year 2025 finishes, your most current return is probably not safe. What are the chances? Okay, we're going to look at some statistics that are based on 2022. Okay, so I'll show you statistics first, then comment on that. So first statistic says, what is the rate or in 2022, this is information as of 2022, of individual tax returns overall across the board? Okay, 0.4%. So not 1 out of 5, a whole lot less. 0.4 is not a huge number. Now let's partition that slightly when we look at that statistics. If we look at low income return, people who claim earned income tax credit, usually like low income families with kids, and you see those ads as you drive, like right next to the bandit signs for real estate, there are signs during the tax season is, okay, tax preparation, minimum 5,000 refund guaranteed, yada, yada, yada. Okay, those places that work mostly with low-income families with kids and claiming that earned income tax credit, which essentially is refund of money that you never paid into the system. Okay, we're not talking politics, we're talking about numbers of IRS audits. They have 3 times the rate of standard audit. Why? Because that earned income tax credit is quite regularly fraudulent by claiming dependents that do not qualify. So yes, the IRS pays more attention to that. Now, the group where many of you are right now on this call, Quest, typical client, saying is income level somewhere between 200 and a million. So in that range, if you don't have business claimed on the individual return, and having K1s is not having a business. If you are a passive investor receiving K1s, it will be in this group, non-business return. So the rate is 0.5% roughly. What is interesting to notice, however, it doubles if you have a business schedule, like Schedule C, claiming your real estate business on that return. The rate doubles from non-business. 1% is 1 out of 100, right? Now, if your income is higher, if you are making over a million as a on the return, doesn't mean individually. So if you are married, over a million combined. Okay, your rate is higher. Okay, 2.4. Okay, now, what do we make out of that? Before I comment on that, let's see, can we rely on those numbers? The answer is no. Those numbers are based on 2022. During the COVID years, there were virtually no audits. In my office, we used to have a fair number of them prior to COVID, not during COVID. It was very, very quiet on the audit arena, right? So the government, as you know, likes to work in extremes. So one day we have 2% rates for loans, and then just a few months later we have 8%. It swings from one extreme to another. So I think the same thing is going to happen with an audits. We see audits activity ramping up already. I expect personally, and most of my colleagues agree, that the rate of audits is going to be sharply up in the near future. Because like I said, government goes from one extreme of no audits to another extreme of a lot of audits. So I expect these numbers to go higher. Will it ever go to my example, 1 out of 5? Absolutely no. IRS never has that kind of resources to audit 1 out of 5 returns, but are we going to stay in 1% area? Maybe not. So what does it all mean? Okay, so, your chances are fairly low. Then what happens if you are audited? What are the consequences? So first, yes, additional tax, assuming if you lose the audit. You don't have to lose. Many audits end up with what is known as no change audit. So the IRS confirms, or rather concedes, that the tax return that you filed is okay. They accept your numbers, you walk away free, only having wasted your time and money if you hired somebody to represent you, but you don't pay anything extra directly to the IRS. If you lose audit partially or completely, additional tax is definitely there. But that's not all. After that come penalties and interest. So first, interest. Interest currently on the federal underpayment as we speak is 8%. 8% is no joke. If you do the math, it's a significant thing, particularly if you realize the rest of that bullet point. The interest goes back to the date the return was due. So if today they were auditing your return for 2020, which right now is like the time frame to audit 2020 returns. They are kind of wrapping it up right now as we speak. So if they decide that you were wrong and assess tax liability for you for 2020, the interest they are going to calculate goes back to April 15th of 2021, when that return was due. Not from today, when they finish the audit, from the day when you owe the tax, which is 2 years, 2.5 years worth of taxes right now, 2.5 years worth of accrued interest. So that thing will not be small. It's a pretty significant amount. That's not where it stops. There is a thing which is called 20% substantial understatement penalty, which the IRS very routinely adds to that. Yeah, you can fight that penalty. You might be able to win. You may not be able to win that. 20% means in addition to everything they calculated, they take extra 20% just as a penalty for you for doing it wrong to begin with. And how they define substantial? Well, 10% of your income or 5,000, that's considered substantial. So if they figure out you owe them 5,000 or more, well, they will add 20% to that automatically. There are all kinds of additional penalties depending on the severity of the issue, and they can add up to a very hefty amount. Now, there are 2 bullet points right now that I hope I never have to discuss with any of you in a private consultation. There is 75% civil fraud penalty. Okay, if you go into fraud territory, like I hope you don't, but if you go, the penalties go way up, and they can go all the way up to criminal penalty, which does include time behind the bars as an option. Now, does IRS put behind the bars people who owe them money? No. The word to pay attention here is fraud. You will have to commit something that they believe fraudulent, and it will be their burden to prove that it was fraudulent. But if they succeed and win the argument that what you did was not done in good faith, that it was done fraudulently, basically, you knew that it was wrong and still decided to put it on your tax return. Now, this is fraud. That can really put you in hot water. And again, I hope nobody is contemplating that. It's not worth it. Okay, so we're going to talk next about reasons to be audited. And the very common folk myth going around is that, okay, if you are cheating, then you are audited. You are not cheating, you are not audited. Okay, well, yes, cheating is common. We all know that, but that's not the only reason. The first reason is, yes, you can be audited if something from the IRS point of view on your tax return is wrong. And we are going to talk next. I will show you examples what IRS considers to be wrong, right? So that's only one, the first of the possibilities. Besides that, what else can bring you on the IRS radar and trigger an audit? Something could be done by another person. Example, who are another person? Tax preparer. So I went to somebody who advertised, okay, I know this magic thing which saves you tons of money, but be quiet about it because it's proprietary secret strategy, and I will do it for you, but I'm not advertising it publicly. What do you do next? You invite all of your buddies, and all of your buddies now benefiting from this magnificent strategy only known by this brilliant tax person. Then the IRS gets a whiff of that, and they audit somebody who is not you and find a problem, and then they figure out, okay, who put that on the tax return? Oh, I see, that guy. Okay. What they can do next, and often do, is they will pull every client of that tax preparer, which might include you, and start like blanket auditing all of them, reasonably suspecting that if he did that for one person, he may have done it for other people. So now they have low-hanging fruit. All of his clients might have the same problem. They love to do that stuff. Business partner happens many times when you, let's say you did a JV with somebody and that somebody was not playing nicely with the IRS, did something which is shady. And I'm not talking shady stealing money from you. That also happens. I'm talking about stealing money from him. Okay, so that guy does not like people who steal money from him. So what can happen is then they can bring into investigation or audits, what we call them, right? Everybody who did some business with that person. Okay, your employer may be in trouble and employees can be involved in an audit because of that. So there are, again, none of that means you did something wrong, but can you still be audited? Yes. There is third reason, which if you look at IRS website, The IRS acknowledges that. Some audits are completely random, like literally like a lottery. Your social security number came up into that lottery. What did I do wrong? Nothing. Your social security number was picked up by a computer for a random audit. Is it common? No, it's not common, but it's possible. So the reason I'm mentioning that is if you receive the notice of an audit, yes, most of the times it means something is wrong on your return, but not always. What it also means is that anybody who promises you that they are going to prepare your taxes and guarantee, they love that word, we guarantee that you will not get audited. That's total bull, because nobody can guarantee you that you will escape the third or the second of those three reasons. Frankly, they cannot guarantee the first one either. But just because there is an option to be audited for nothing being wrong on your return at all of those guarantees that you will never be audited if you do business with us is empty and like unethical marketing is all I can tell about that. Now, what does not get you audited? Let's have a few lists of things that some people believe are a problem, but really are not. First, if you claim deductions and you're eligible to them, no, it does not trigger an audit. Now, the magnitude of those deductions and the way you present them may be, which I will show you on examples shortly. But the fact, if you are eligible to that, and home office is a typical one, I think, never claim home office, it will get you audited. No, it won't. It's one of the legitimate deductions. And can they look into home office while they audit you? Yes. Does it mean that home office triggers audit? No, that's a completely legitimate deduction. You can have business losses. Having business loss does not mean an audit. Having suspicious business loss may, but be a little patient with me. In a couple minutes, we are going into examples. Not keeping receipts and logs. That cannot trigger an audit. IRS has no way of knowing whether you have receipts, logs, and all its documentation. All they see is your return. They may gamble that you don't have your receipts if you wish, but they don't know. Maybe you have perfect documentation. So yes, not keeping receipts will make your audits a lot more difficult, but it will not trigger an audit. Okay, some people believe is okay, if I have a huge refund, or the opposite, if I owe the IRS huge amount of money, that triggers an audit. No. What they look at is the amount of tax related to your income, but not necessarily refund or the amount that you still owe to them. Filing electronically. Now everybody files electronically these days. Surprisingly, there are a couple people on YouTube who up to this day claim this. Avoid filing electronically, send it on paper, that way you will escape audit. No, that's not true. And I'm not going to spend time like debunking, trying to shoot down this myth. And last one, also very popular on YouTube, saying is, well, you need to file always late, like with an extension, because by that time they selected their audit. Remember what I mentioned to be the time frame of an audit? 1.5 to 2 years after. Way past all of the extensions. You will, extensions or no extensions, all of that will be in the same pot from which they are going to pick your returns. It makes no difference. So what the IRS considers worthy of an audit. Before we do that, I need to mention the process of how audit selection does. It's first done by a computer. Computer assigns to every return a score, which IRS calls DIF score, which is not unlike credit score. You get like good points for good behavior, bad points for bad behavior, then computer adds it up, and if you are above their secret threshold, now the IRS never discloses how your FICA, so to speak, or like DIF, what is that score name? How exactly it's calculated is a tightly protected IRS secret. Many people claim to know that. I don't trust any of these people. I don't believe that information is really known to anybody except a limited number of in IRS insiders who work on that thing, and that algorithm is evolving, changing all the time. So I don't believe that anybody can tell you how it's calculated. But from experience of seeing audits, we derive kind of rule of thumbs, seeing as what gets noticed. So, okay, first that score, computer flags you for a high score. And then it gets to a human being, like an employee of the IRS, who looks at that return with human eyes and saying is it worth further step? And if they decide it is, then they refer it for an audit. Sometimes they can look and saying yeah, I see computer didn't like something, but I don't think it's worth messing with. And you never even hear that the computer didn't like something. So what the computer will pick up? There are three areas, basically. First, when something looks definitely breaking the rules, like this so-called driver license, right? Computer notices something that cannot be true, and they flag it. Second, mismatch. All of these are businesses that you deal with, not all, but a lot of them are reporting your income to the IRS and sometimes your deductions, like mortgage interest. And the IRS computers compare what they know about you against what you claimed on your tax return. If they notice that something does not add up, and I'll show you a couple examples, they can flag you. Third one is just unusual story. Something on your return is not looking the way it normally looks. So it doesn't mean it's wrong, but it's kind of oh, well, we don't see it often. Maybe it's worth looking at. Examples. There will be 10 examples that I will quickly go through. First example is losing too much money. So here is what we have on the return, like screenshots of some of the things that our clients brought to us, prepared usually somewhere else. There is only like 1 or 2 examples out of these 10 that we prepared. The rest was by somebody else. But here is a good example. You make 145 here in salaries, and then you have 90 something business laws dropping your income from 150 to 50. So 2/3 of your income is erased by losses. Okay, is it an IRS audit flag? Yes, it is. Can the loss be completely legitimate? Absolutely. Can you win that audit? Yes, if the loss is legitimate. But can it still be flagged for an audit? Likely so. Second, business schedule that shows zero income, large expenses. We see them all the time, and most of the time it's incorrectly presented. Occasionally, this truly is a situation. You had a year when you operated a business, had zero income, as the top red circle shows, right? But had like 90,000 worth of expenses in that year. Can it happen? Yes. Sometimes it is the true story and legitimate. A lot of times it's not. The IRS knows that a lot of times it's not, so it is an audit flag. Rounded numbers. Very popular thing that people who prepare returns themselves do, and occasionally we see that done by so-called professionals. Return looks like that. See there, everything is rounded, almost everything, right? Except car deduction. Everything is rounded to 1,000. You know what? That car deduction was also rounded because they had rounded number of miles. They put there like 30,000 or 20,000 miles. Again, so everything here is rounded to 1,000. What the IRS sees there is, okay, he guessed. Oh, if he guessed, he probably does not have good documentation. What are we going to do to him? Audit. Fourth example, repairs versus improvement. There is a big distinction, which is not topic for today. When you fix the new property, it's always repairs. Okay, yeah, we do. Okay, we bid on a property, we look at ARV, and we're saying, okay, the property needs 50,000 worth of repairs. Well, repairs, in investor language, yes. In IRS language, that could be capital improvements. So when they see something like that, 33,000 worth of repairs, that's an audit flag. Especially in a situation like this example, which had rent in the column A 0. So what it tells the IRS, the property wasn't even ready, it wasn't rented, They just bought it, started rehabbing that, put 30,000 into that and trying to deduct it as an expense. No good. We are going to audit that. Number 5, using wrong IRS forms. Okay, so which forms you should be using? Realtors and wholesalers, flippers and builders should use Schedule C. Rentals always use Schedule E. A lot of people who prepare return themselves saying as well, I don't see where is a line for that. I have rental property, but I don't see a line for education. Where do I put it? Oh, there is a line for that on Schedule C. So I will put that on Schedule C. No, wrong. You will be asking for an audit. Now, STRs, short-term rentals, my bullet point says ask your accountant. Okay. General rule is it's normally Schedule E. Very rarely short-term rentals will be on Schedule C. I would go as far as saying almost never, but there is occasionally an exception. So short-term rentals normally should be on Schedule E, but to be sure, you have to discuss your specific situation. Private lenders also can be on different forms, and that is case by case, so I cannot give you an advice of where it goes. 6, amending your return. Amending your returns meaning is, okay, you filed your return, it showed a lot of money that you owe to the IRS, and you decided, yeah, maybe I could claim more deductions. So then you start doing second version and put more deductions, and now you have second version, which is called amended tax return. And that return, now you owe like less money to the IRS, which is a relief, except don't be surprised that the IRS, instead of sending you the refund from your amended return, can send you a letter of an audit. They always like to investigate situations because, again, look at that from his point of view. So he says, okay, dude, first you told me you owe me 50 grand. Then you freaked out, decided it's too much. Now you're going to tell me a different story where you only owe me 5 instead of 50. Okay, let's see what's going on. Number 7, not including income from 1099. So there are 2 types of 1099s. NEC is non-employee compensation when you work for somebody as a contractor, and miscellaneous for things like rent, for example. And there are all kinds of excuses that I list here that people saying, well, I didn't include it because I forgot about it. I didn't receive it. Okay, my property manager put wrong information there. Okay, that section 8 reported something wrong. All of that is, yeah, they reported it, but. Remember this, the IRS computer matches things. So if the IRS computer has a copy, and they always have copies of your 1099s, computer sees that your 1099 said 55,000. They look at your return says 45. Maybe you only made 45, but your return should show 55, and then the 10,000 deduction to make it correct. But it has to start with the same number that IRS computer is looking for. Otherwise, you might be in trouble. 8 is similar. When you sell a property other than your own residence, the title company sends 1099-S to the IRS. All information that is there is what was the total sale price. And a lot of flippers especially fall into this trap saying is, no. I know I sold it for 200, but I only made 10,000 on that deal, and they report 10,000. No, wrong reporting. You have to report 200 and then 190 worth of expenses that went into that. You will still pay taxes on 10, but you have to start with the number that was on the IRS form that IRS computers is looking for. K1s, same information. With K1s, beware is that they almost always come late. They are often revised, so it's not, when you have K1 investments, my recommendation is don't rush your return. File an extension, wait until you have final versions of K1 so you don't have to undo that. Okay, also when you look at K1, couple warnings, the last 2 bullets. Income that you pay taxes on is not the same as distribution. Like cash distribution and taxable income are 2 completely different things. And also, if you invest in a syndication out of your Quest IRA account, when you submit your paperwork to become a passive partner in the deal, make sure that you give them EIN number of your self-directed account and not your social security number, because if you give them social security number, the income will be reported as your personal income instead of income of your self-directed account. Last one, number 10, is not income but deductions. When you have mortgage interest, you get normally 1098s. That's if you really hold mortgage. But sometimes you don't. You can have hard money, and hard money lenders, many of them are not very diligent in, some don't send 1098s at all, some send them wrong. So often that information will not be reported to the IRS. Then you have property managers, I'm sorry, here PM is not property manager, private money. Private lenders almost never send you 1098s. They should, but they don't. And you may have a sub-2 property, which the mortgage is not under your name, under the name of the seller, right? So all of these situations, people still put it as mortgage interest, but IRS computer does not have the match between your social security and 1098. They are going to ask questions. How do you address that? If you don't have 1098, make sure that it's not reported on line that says mortgage interest. It needs to be on the line that says other interest. That way the IRS computer will not be matching. Number 11 was bonus. I promised 10. This is number 11. Real estate professional status. Remember I said there were 3 situations, right? The situation, like when something is fishy, something does not match, or that third situation on the right, just strange story. Guess what? Like real estate professional is a strange story. Why? Because normally, okay, here your income is over 150, 170, if you look at line 7. And line 17 says, but you are claiming losses from rentals. Normally, you cannot do it when your income is high. If you're a real estate professional, you can. But is it a flag? Yes, because it's not standard. It's not something that you normally are allowed to do. Does it mean you shouldn't claim real estate professional? No. If you qualify, you should. What it means is, if you don't qualify, then you should not, because this is an audit flag and you're very likely to be pulled for questioning and done that. Okay, we are close to the end of the presentation. I'll quickly mention 2 more issues. One is types of audits. So first one is, okay, people very frequently receive a letter that says something like that. We made an adjustment to your return, blah, 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 blah. That's not an audit. What it means is the IRS computer corrected something that believes is your mathematical or recording mistake. Example is, your tax return says that you transferred refund from last year into this year. So you apply 10,000 from prior year to this year's taxes. The IRS computer checks that and says, that wasn't 10,000, that was only 8. They will make an adjustment, send you a letter. Not an audit. If you believe they are correct, you're just saying is, oh crap, and go with it. If you think they are wrong, you write them letters trying to explain that they are mistaken, but that's not an audit. Second, very often people receive a notice that is known as CP2000, which basically is a letter that says, look, we think you missed something. Like, we have a 1099, we don't see it on the return, so we think you underreported your income. We added it as a favor to you, so, no thank you needed. We did this favor to you. We nicely applied this additional income to your return, recalculated your tax liability, and this is what we think you owe now. Remember, it's a suggestion. If you look at that and realize, oops, they're right, that really was a mistake, well, then you go, you concede that adjustment and pay, right? A lot of times there you look as, no, that's wrong. It's reported, but not where you are looking for that, in a different place. Or there is another reason why they are wrong. Then you have to send them letters. Again, this is not an audit because they are not asking you to prove anything. They only found something that they believe you overlooked and they are trying to quote unquote correct it. Okay. Real audits are these. Most common audits, 60 or 80% of that. Why such a range? Because it depends. If that's a business, it's 60%. If you don't have a business, 80%. Correspondence audits is by letters. You receive a letter will usually indicate specific information they want to check. They're saying is, on your return, you claimed 50,000 worth of interest. please provide proof that you actually did have 50,000 worth of deductible interest, or you claimed 70,000 write-off for business use of your automobile. Prove that you are entitled to that deduction, and so on. Response to that is by letter. You write them letter, you send them documentation that is requested. That's most of the audits. Second type, which is called office audit, is when they're saying is, okay, your return is selected for an audit. So here is a long list of things that we are going to look at, and we're scheduling an appointment with you. In the past, it was mostly inviting you to the IRS office. Right now, a lot of them are through phone calls, but this is a true audit where they are looking at a wide range of issues. And the most severe one is called field audits, is when they come to your business, make an appointment. They want to visit you usually at your place of business, go through your records, and the indication that you are dealing with a serious audit is when the letter is signed by somebody with a title of revenue agent. Revenue agent is a high-level auditor, and if you are dealing with that, you probably should not be fighting alone and hire some help. If you are confronted with people who wear guns and have badges and introduce themselves as criminal investigation division, don't talk to them, don't let them in, hire an attorney. That means you really are in trouble. Very rarely happens, but it does happen. Don't make a mistake of responding to these people right away. Your response should be, thank you, okay, I'm going to hire an attorney to represent me and contact and give him your contact information. Okay, and don't confuse collections with audits. People think, oh, IRS keeps sending me letter, I owe them money, they are auditing me. No, these are completely two different departments of the IRS. Audit people want to figure out how much you owe, then don't care if you pay it or not. They just want to figure out how much you owe. Collections people don't care if you really, if your return is correct or no. They look at, okay, computer says you owe us money, pay. So two completely different things, not really related, and not really knowing what the other hand is doing. And last one is audit success keys. So I'll quickly go through them. In fact, I will put them all on the screen right now. I hope that all but two of them make immediate sense. Okay, so second one, organize your document. No, don't be funny and bring them shoebox and dump it on the desk of your IRS auditor. It's not going to help you at all. It's not funny, it annoys them, and they're just going to give you to reciprocate by giving you equally hard time as you're trying to give them. Okay, now the two important pieces are two bullet points towards the end that may be counterintuitive. So one is, okay, don't argue fairness. I hope that makes sense. A lot of people love to argue and explain how it's fair. You know what the IRS auditor is probably thinking when you are doing that? You know what's not fair? What's not fair is that you're making 3 times the amount of money that my salary is here, and you're trying to talk to me about fairness. And I work for the government. I have no business deductions. So shut up. You don't get any sympathy from me. As far as don't argue tax law, this is a frequent mistake. IRS auditors are not trained in tax law. They don't know tax law. They don't understand tax law. They are not supposed to. What they are trained on is reconciling bank statements. They want to see that everything that went through your bank is reported on your tax return. They are good at that. If you are trying to say, but the law says that as a real estate professional, I am entitled, blah, 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 blah. Okay. One time I had a conversation like that with an auditor. We were arguing. She called for her manager. Her manager came there, stood like that at the entrance of the cubicle, says, what's the problem? I'm saying, well, the problem is, okay, your employee claims this, which is completely wrong under the law. So she says, you want to argue law? That was years ago when I was young and didn't know better. She says, you want to argue law? I says, absolutely. She says, great, go to appeals. Appeals is the next level, above exam, above the auditors. Those people are trained in law. They know the law. That's where you argue the law. Arguing the law with auditors is pointless. You can try, but don't count on that. They are ignorant about the law more often than uh, they know what they're talking about, because again, that's not what they are hired for, not their job. And that's all for the presentation. I need to have two things mentioned. One is questions. A lot of times we're saying is, okay, so I have questions about that. Can I follow up? Sorry, you can't. This is why. It's okay. The only people we will answer questions about individual situation is people who are our clients. You have two places where you can ask questions for free and people will answer them. First one is right now on the screen, Bigger Pockets. Bigger Pockets is the largest national online community, and not just online, they have like conferences live and all that stuff, like huge community nationwide, actually international, of real estate investors. Very helpful. If you are not member of Bigger Pockets, absolutely join right now. And they have a tax, self-directed IRA, and cost segregation forum. All your tax questions can be posted there. They're like, I'm one of the top contributors to that forum, but that's the forum where people like me answer your questions for free. Other place is here. Together with an attorney friend who most of you know, John Heyer, like we co-host this private Facebook group called RAI, Tax and Legal Wizards. Also a place, this is private group, so you have to ask for permission. We'll grant it to you, obviously. Okay, so, and then you can ask also tax or legal questions for free, and often they are answered. Everything else, you need to become clients. My company is RAI Tax Firm. The website is at the top, www. Real Estate Investment Tax Firm, raitaxfirm.com. We only work with investors. If you miss my introduction, that we work it since 96, so like close to 30 years, have a lot of experience. And I'm Michael Plux, wearing like these red gloves to beat up Uncle Sam, and wearing my black belt as being black belt in real estate taxation. Thank you all for staying with me. Good luck in your real estate business and stay safe from the IRS trouble.
Thank you so much, Michael. That was an excellent presentation. I think we found it very educational. I'm going to share with you guys some slides just to give you a little information about Quest Trust. This is a quick disclaimer. While we greatly appreciate and enjoy the presentation, we do like to disclaim that Quest Company does not provide tax, legal, or investment or structured advice, nor do we endorse any product, services, or investments of any type. We highly encourage you that all the information and material we share with you are educational purposes, and all parties encountered to consult with your attorney, accountants, and financial advisors. Also, make sure to scan this QR code if you want to take care of your financial future. We have a team of IRA specialists who would be happy to answer any questions as well as share the presentation that we had today. Michael, thank you very much. That was very interesting, and I think we all learned something great from it. If you want to know how you can use your IRA for planning your financial future, you're more than welcome to give us a call. Use this QR code to schedule your free consultation, and we can also tell you more information about how Michael's services will be able to assist you with your IRA accounts. Also, we would like to invite you to our rental continuum, decoding short-term and mid-term rentals. We will be having an online event November 7th. However, if you are in the Houston, Dallas, or Austin area, we will be hosting those on different days. Our Houston location will host the event November 7th at our office at 6 p.m. And we will have a panel of experts in the area who can talk to you about their experience and some ways that they have found success in the rental industry. Please make sure to join us. Like I said, whether you are in the Houston, Austin, or Dallas area, we would love to see you in person. We will have an open bar and some snacks and some great education. Also, if you have not registered yet, we highly encourage you to register for our QuestCon Live. which is coming up in a couple of weeks. We have an amazing panel of women and speakers who will be telling us about the industries, leading investors. We have some fabulous keynote speakers, and we'll give you a little bit of every information from rental to starting your own business to how you can use your IRA to make wise investments. This is going to be the first time that we have an all women speaker and panel. However, you are all invited to this, and we highly encourage you to learn from these incredibly smart women. Make sure to register today. The event is free, and we look forward to seeing you. And lastly, we would like to invite you to save the date. Next year in June, we will be holding our Quest Expo. So far, we have about 750 vendors, speakers, and panelists who will be joining us. We are very excited about this event. We were not able to put it together this year, but next year will be bigger and better, and we look forward to seeing you there. I believe early bird pricing is still in effect, so if you'd like to, scan that QR code, and we would be happy to get you a ticket. And last but not least, this month we do have two coupon codes that are hanging out. The first one is going to be uh, our Halloween code. If you would like to open your IRA, whether it's a traditional or Roth, we are happy to help you and waive that account opening fee. Again, you can go ahead and make an appointment with any of our IRA specialists. And if you want to do a Roth conversion, next month we will also be having a promo which will help you by saving you your first asset purchase. But from now until Halloween, use code Halloween23, and we would be happy to waive that account opening fee. It looks like we have some questions in the queue. Michael, if you'd like to give these a try and see what questions we have.
I don't want to hold people for a long time, but okay, I will run through them quickly, without detailed explanation.
Of
And
course.
what I mentioned, like there are a couple places where you can continue that conversation. Bigger Pockets has a tax forum, and we have a private Facebook group. Okay, so going through that is okay. We have introductions. Okay, okay. Do you save a tax return for the past 3-5 years? Yes, I would, and I mentioned before, if you have a property that you purchased 20 years ago, which you still own, you really are well advised to save all of those 20 years until like 3 years after that property is sold. Will it be necessary? Hopefully not, but it's a good precaution to keep all of that. Okay. Lisa, thank you very much for your very helpful answers on that thread. Okay, so everything you say is correct, of course. Okay, how much of a responsibility does tax preparer has? A lot. Actually, tax preparer can have huge penalties as well, including jail time, depending on how negligent they are in preparing your return. But if you are asking this, if your return is incorrect, will the tax preparer pay your taxes and your penalties for you? The answer is no. Depending on your engagement, you can try to sue your CPA to reimburse you if that's what you are asking. Now, if there is a mistake on your return, like if I was a crooked preparer and I put there something that shouldn't be there, you will owe the IRS because you underpaid taxes, and I will be penalized separately by the IRS for being a crooked preparer. But I will not be forced by the IRS to pay your taxes and your penalties and your interest. Okay, what does owing a lot of money mean? Great question, Ramas. Okay, and the best answer to that is, I don't remember which comedian said it, but it says, $1,000. Is it a lot of money or a little bit of money? It depends. Do I owe you? Do I owe it or do you owe it to me? Okay. Can they issue 1099 with just a name without social? As Lisa correctly answered, no. I mean, they can send it, but it's not going to be against you because the computer cannot connect it to you. Okay. My tax preparer combines small and big amounts together, reported as 1099 services. Is that okay? I don't know the detail about that. Maybe okay, maybe not. It really it's not a very detailed question. Okay, what determines if you are a real estate dealer? No way to answer that right now here. Separate thing, but that's a great question to ask in one of these two places: Bigger Pockets Tax Forum or REI Tax and Legal Wizards Facebook group. Real estate professional, can my spouse be the professional? Yes, absolutely can. That's exactly what a lot of people are doing. One person is a physician making $500,000 on W-2. The other one is full-time real estate professional, and they qualify for all the benefits as a couple. Can a business as corp claim capital gain taxes on a flip property? This is a contradiction. Flip property does not have capital gains. That's not capital gain, period. That's ordinary income. Okay, so if they held it for more than a year and it was a flip, it's still a flip, still not a capital gain. Now, can a business S corp claim that income? If it's capital, if it was a rental, then capital gain. By the way, if it was a rental, should not be inside an S corp. But if it's really capital gain, it could be on S corp. If it's ordinary income from flip, could, yes. S corp can do all of these things. Just one warning: S corps are severely over promoted and oversold. That's not a no-brainer by any means. S corps can create more harm than benefits. Always get good advice before creating S corps. Okay, 1099s.com, but I still add it anyway. That's what you're supposed to do, right? Absolutely correct. And the rest is okay, Quest announcements. By the way, Quest, like we always send our clients to Quest for both for services and education. Education at Quest is unparalleled, like wonderful presentations all the time. And last question from Fred: can one do installment tax payments on the income from sale of a sub to mortgage rep? Okay, sub to mortgage rep is how it's taxed is a completely different question. Okay, so what I do not know is whether the question is about installment payments to the IRS or can tax treatment. I think it's the second one. The first one was is if you owe to the IRS, can you have installment payments to the IRS? Yes, it's like payment plan with the IRS. Yes, they are very common. But I think the question was about tax treatment of a sale of sub to mortgage rep, and that's a complex question that is unfortunately like not suitable for Q&A right now in this quick thing. Evelyn, thank you for giving me a chance to reply to these questions. And again, thanks everybody for attending, listening to us.
My pleasure. Thank you so much for giving us a great presentation. And that concludes today's Self-Directed IRA Saturday. Thank you, everybody. Have a great weekend.